I think there's something important. Let's assume the LBMA are right, and I think they are in this saying it's a misconception that Basel III is changing it for gold. Therefore, what everyone's saying is that gold has to move into the banks for physical. That's rubbish. So I mean, there may be a vested interest in saying that because obviously gold is leaving London and going to New York, and a lot of people are saying it's going to New York because the banks want to have the physical allocated gold in their vaults ahead of Basel III so they can count it against their reserves, which now LBMA is saying that's not true. So that begs the question, why is all the if it's not true, why is all the gold going to New York? Who in America is taking delivery of all the gold?
Yeah.
It's not what we thought, or it's not what some people suggested. It's certainly not the banks saying we've got to have gold in our vaults anymore, because that's not
Yeah.
necessary if this what they write is true.
Friday, May 16th, 2025, Monaco 64, home of alternative economics and contrarian views. Hi, Clive.
Good morning, Mario, and welcome to Friday.
Yeah, we're back. They're still here, the builders. They're going to be a couple more weeks, but the study's almost ready. So next Friday, I should be back there. Uh,
I like the painting on your wall. Who's that by?
Actually, yeah, it's one of the viewers, a long time subscribers and followers of the channel, and he's in the UK, and I paid for it, and I paid half cash and half silver. So he accepted silver for payment. It's a beautiful painting, actually.
It
And
looks lovely.
yeah, so it's from the Monaco 64 community, one of the long-time followers. Clive, you've noticed that Comex gold deliveries have gone through the roof for the month of May, and we're only like halfway through May. And I had also been looking, Clive, at bond yields that they're starting to look uncomfortable, I think, for the powers that be, for finance ministers, for chancellors, for secretaries of the treasury. And you've noticed the same. So maybe we could touch upon what's happening in gold on Comex, and why you think that's significant, and also how, and then you and I can talk about how that could be related to the bond market, right?
So yeah, first of all, what I was noticing was the Comex deliveries. So every single month this year, January, February, March, April, and May, the deliveries of physical gold bars under Comex are more than 200% higher than they were for the same months a year ago. And in fact, this month, the month of May, we're only halfway through it, and the deliveries are 700% higher than the month of May last year. So the puzzling thing is this has been going on for 5 months, and we do not know who is taking delivery of these baths. But someone out there has taken the decision to get delivery of 100-ounce bars. This is sort of 300 and something $1,000 each. So this is not mom and pop. This must be a big player or big players. They're taking delivery, and they're staying mum about it. They're not talking. They're not saying it's us. And anybody who's in the know is no doubt sworn to secrecy and keeping their mouths shut. So there's lots of theories as who could be taking delivery, ranging from the U.S. government to Berkshire Hathaway to big hedge funds. We don't know. It could be Canada. It could be China. I mean, I think it's unlikely to be China. Why would they buy gold out of New York when they could buy it from London? But long or short of it, someone somewhere is demanding an exceptionally large amount of 100-ounce bars from Comex, and I guess I'll let your viewers put their speculations in the comments as to where it's coming from. But I really don't know. I can only guess. What do you
Yeah,
think, Barry? Any ideas?
well, yeah, I think Berkshire Hathaway could be. That's one of the big candidates for me because of what Warren Buffett said. I think at the beginning of the year, you noticed that he made a comment about paper money always being like going to zero or always losing value. And the fact that he retired recently, and maybe there's this new guy he's looking at it, and when you have 330 billion in short-term T-bills and cash, and you believe that the the money is the paper money is no good. It's a big risk, I think, having too much cash. So I think could be one of the major candidates. Also, the U.S. Bullion banks on behalf of the U.S. Treasury, because I think a lot of the gold that they're they supposedly hold 8,131 metric tons. I think that's been leased out many times over, so they're actually having to get physical delivery. Yes, they did talk about an audit, and it's gone really quiet. And I think it's gone quiet because they can't do the audit until all the metal is in Fort Knox or West Point or Colorado. I think they keep it there under the airport somewhere. Yeah, so yeah, like I said, it's speculative, or maybe very wealthy individuals. They realize that something's wrong with the system. And what you say here, everyone wants the physical metal, not just paper promise, because we know, Clive, you and I, and hopefully a lot of our viewers, that if you don't really hold it, you don't own it. Yeah, some of us, of course, keep some of it in private vaults, insured. But yeah, do they really want that gold in Europe when there's a danger of more geopolitical tension?
Well,
And
well sorry, go
yeah,
ahead.
no, that's it.
Here's a little bit of a conspiracy theory for you and your viewers. There are widespread rumors that China owns a lot more gold than they're owning up to. In other words, they have a huge ton of gold they haven't told anybody. The reason they would want to have so much more gold than they're telling people is when the system fails, they want to be the leading seat at the table with the most gold to reset the system and write the rules rather than have the United States do it. But maybe the United States knows that through their secret service and their spying and so forth. And therefore, the United States is trying to outfox the Chinese by secretly acquiring a whole bunch of gold so that when time comes down to sit down at the next Bretton Woods or whatever they have to agree a new world monetary system, America says, you don't have the most gold, we have the most gold, so we set the rules. Could be.
Yeah, maybe they call it they might call it the Mar-a-Lago summit, but that isn't a conspiracy theory to us, Clive, because we've covered here many times the fact that China probably just the government or the central bank, they have over 30,000 tons, and that's been like written about by people like Alistair MacLeod, Dominic Frisby, I think Jan Neuenhuis maybe, and others. And one of the ways they've calculated this is that China is in the top two of gold producer. I think is number two. Russia is number one, and they haven't exported any of the gold that they've produced over the last 20 years. So it stays there. And a lot of the gold is bought by the PLA as well. And the PLA, of course, answers to the government and the central bank. So I wouldn't be surprised. And like you said, the U.S. Authorities, they probably know about this. They maybe they watch our conversations, Clive, and other people in the alternative, in the gold bug space, or maybe they know it as well. So, and I spoke about the bond market because I mean, if you think about the bond market, Clive, is just a cash market, but for cash like that you borrow longer term. Cash is like spot gold, let's say cash, and bonds are like forward gold contracts. But yes, and the debt's gone up so much, and the deficits are not coming down. And I think investors are starting to get worried, and you notice that too. And before we show what you talked about bonds. I just wanted to show you an article because I was thinking about talking about bonds as well, and then you wrote about it. But this is from a couple of days ago on Bloomberg. So, U.S. may need a bond market blow up to cut deficit, market veteran says. So, why would that cut the deficit? Well, I guess it would wake people up to the fact that they can't keep, Congress especially, and the administration, they can't keep spending and borrowing like the U.S. has for over 50 years. So it says here, I think it's a guy. It says after the November election, there were a few people in the bond market more optimistic about how President Trump and his band of Doge cost cutters would rein in ballooning budget deficits than Stephen Jen. 6 months later, Jen, a longtime market veteran who runs Horizon SLJ Capital, is backing away from that call. In fact, he's become so discouraged by the fiscal largesse he's seen from the new administration that he started to wonder if the U.S. needs a bond market blow up akin to the one that did in the UK Prime Minister Liz Truss government to force it to change course. And I think this guy, he used to work for Morgan Stanley. He's quite a well respected analyst. So, what do you think, Clive?
Well, look, around the world, Western bond markets, particularly the 30-year, which is a very long-dated bond, uh, they're all flashing red, which is a danger sign. And when I say they're flashing red, despite governments having cut interest rates, or the central banks having cut interest rates in almost every country the last year or so, the 30-year bond yields are literally at as close as makes no difference to the highest level ever. So whether we look at Australia, Belgium, Canada, I'm looking at a chart here, Germany, Spain, European Union, France, Great Britain, Italy, Japan, Netherlands, United States, all of them are very, very close to the highest. I won't say the highest yield ever, because I don't know what the highest yield ever is, but they're very close to the highest yield in the last 5 or 6 years, or maybe 20 years. And it looks like we're about to have a blow off in the yields, and the yields go higher, probably in the United States, where we could easily go to 5% in the short term. We're at 4.4 or something like that at the moment. Japan is looking particularly precarious with the okay, the yield's not a high level, but it's just gone straight up, 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 and up, and that's dangerous for Japan because they've got a very high level of debt versus GDP. So as the interest rate on these long dated bonds rises, it means that they're refreshing their old debt, which was close to zero in interest rates. They're refreshing as it matures at these much higher rates, maybe 10 times as high in terms of interest rate. And that's going to start to bite and eat and cause the budget deficit to swell even faster. And the same principle applies all over the world because almost every country has an average yield that they're paying on the debt, which is much lower than the current yields that you see in the marketplace. So I think we're entering a very a danger zone, and we might get to a situation where there is no choice but for the central banks to step in and buy the bonds being issued by governments that the public won't buy or they can't buy anymore because they've allocated enough to that market. Mario, what do you think?
Yes, I agree. And the UK is probably the worst, even though we had a crisis in 2022, because the average duration of UK debt is very long. It's like 15 years. So it's going to affect the UK even more as old bonds mature. And like you said, this is I mean, in the 70s, late 70s, early 80s, I think a lot of these yields, and even the early 90s in Europe, we saw double digit. I remember double digit short-term rates in Italy, let alone 10-year yields. But like you said, in the last 20 years, we haven't seen rates at these levels. And if you look at longer term charts, the bear trend for yields, which is a bull trend for bonds, that's been broken completely. And Clive, I remember in the early 80s, mid 80s, even though I wasn't even working yet and I wasn't in the markets, people talking about inflation and that it would continue. And they're still in the psyche of the 60s and 70s. And then all of a sudden, inflation started going down and it didn't happen. And I think it's the same thing in reverse now. They think we're going to go back to 0% yields and that inflation is going to be under control. But I think they're totally wrong. Unless, of course, like you said, the central banks uh, print like crazy. And maybe that's why uh, the smart money wants physical gold, Clive, because it's not just a government bond market that would be under threat, but also the banks.
Well, look, there's no doubt in my mind that at some point before this decade's out, we're going to have some sort of monetary reset. Now, that can take many, many forms. And one of the forms might be some kind of new gold standard. But when people know that's happening, you will not be able to buy gold anywhere. In fact, you won't be able to buy anything which lasts. People will be buying stuff even though they don't need it because they want to put their money into things which will come out the other side of the reset, and still have a value. So, what I'm trying to say here is, if you want to be sure that you can come out the other side of what's coming, you better buy your gold now while you still can.
Yeah. And the other thing I noticed the other day, another article here from the FT this time, and this is from yesterday. U.S. poised to dial back bank rules imposed in the wake of '08 crisis. Regulators preparing to cut capital requirements that are the target of vigorous criticism from Wall Street. And it's the SLR, it's the statutory leverage ratio that right now doesn't allow the major Wall Street banks to buy as many treasuries. So I think the Trump administration wants to lift these regulatory, let's say, rules uh, because they need buyers for treasuries. I think this shows desperation.
Yep. I mean, clearly they're going to run into a problem at the point they raise the debt ceiling. So, since the 2nd of January, the US government has hit the debt ceiling. They're not allowed to borrow anymore, which means they're now, since January, in what's called emergency measures. That means the government is doing a variety of things to still keep paying its bills, including paying the interest on the national debt, such as running down its cash balances and raiding the government pension plans, or rather not contributing the way they should. And they're going to put that right once they raise the debt ceiling without loss to the pension plans, so they say. But what this does mean is that when they raise the debt ceiling, which has really got to be at the very latest by early August, otherwise they will actually default. They've got it. Basically, it means that come some point, July or August, they're going to have to borrow a huge amount of money to replenish the coffers, to put themselves back into the position they were immediately before the debt freeze. And what that does mean is the national debt at that point can start to rise again, and it's probably going to rise by within weeks of it happening by at least $1 trillion. So where's all that money going to come from? Are investors queuing up to buy U.S. Treasuries? I don't know. We'll see. So they've got to generate a way to move the demand for treasuries upwards somehow and prepare the market. So I think by the time we get there, first of all, we'll have had quite a few cuts in the short-term interest rate from the Federal Reserve to make it less enticing to have money in the money market funds or bank deposits and so forth, or T-bills, so that people say, I'll go for the longer dated bonds so that I can get the higher interest rate. So, yeah, I think that's. But of course, the trouble is, will they get those buyers? Will those buyers be around? We don't know that. I mean, I think the foreign buyers are edging away from treasuries at the moment. The evidence is that most countries have not increased their treasuries, and a number of them have reduced their treasury exposure in the last year or so. And I think the nervousness about not knowing which way the US goes, and obviously this worry about Steve Mnuchin's recommendations about imposing tariffs and forcing foreign governments, or no, big pardon, not forcing, inviting foreign governments to voluntarily exchange their short dated or their medium dated 10-year bonds for 100-year bonds at low interest rates. I think there's a sort of nervousness about this whole thing. And people say, well, do I really want to have all my money in US treasuries as a central bank? Do I all my reserves? It doesn't make sense. Perhaps I should have something different.
Yeah, I don't think it's another Steve. I don't think Steve Mnuchin.
Wasn't it him? No, it wasn't. No, it was, yeah, it was,
Mnuchin or something. But yeah,
yeah, I may have said the name wrong,
he's
yes.
saying exchanging like short-term treasuries for 100 year ones. The other thing, Clive, is that if with all the tariff situation going on, a lot of countries are trying to diversify their trading activity with other countries so they don't have to be dependent on selling to the US. And if that happens, that means they're not going to be earning in dollars. They're not going to need treasuries. So I think this tariff war is another shot in the foot, so to speak. And maybe that's what Trump wants. Maybe he does want the dollar and treasuries to go down the drain and to make the debt more palatable. And the other thing you said is that the Fed might cut rates a few times before the debt ceiling has to be lifted. But what if they don't? And even if they do, Clive, since they cut rates in September last year, the 10-year Treasury yield has gone up like almost 100 basis points.
Yeah, I mean, the Fed officially is independent and doesn't do what they're told. All I can say is if you look back in history, it's never been a great idea not to do what you're told when the people who are telling you what to do are the ones in power.
Yeah, that's right. That's right. And I think Powell has till May next year as the chairman of the board. Um, And Clive, also, I notice gold and silver, they've been very volatile. Like, for example, yesterday, the low in gold was 3,120, and then we closed the day above 3230. So it's a little bit like a yo-yo, and so is silver. But I think I look at it as a roller coaster ride uh, to the moon, right? It's going to be really up and down, and you need to get immune to it because it's been happening for 20 years, this kind of volatility. But in the end of the day, I think we're seeing, the smart money get physical gold. So I think that's a good sign. And the what have you noticed? What do you think about that? And what have you noticed as well in the mining stocks?
Well, I can imagine that perhaps some of your younger or less experienced viewers are disappointed that gold isn't going in a straight line towards the moon. No asset on the planet ever does that. Every asset on the planet, whether it be a bull market or bear market, has its ups and downs. And at the moment, I see that we're in a short term. Well, I suppose it's short. It is short term at the moment. It might turn into long term, but it looks like it's a short term downwards trend, and that obviously can continue for a little while. But given that the long term trend remains up, I believe that this short term trend or downwards trend will reverse itself soon. So probably, I think we will be the long-term upwards trend continues simply because the long-term downwards trend of money will definitely continue because they're going to print more, especially as we get especially as governments are running budget deficits everywhere on the planet. So it's only a question of time before the upwards trend in gold continues. So I think it's quite likely that we'll be ending the year at levels which significantly exceed the all-time record that we've seen earlier this year. So I'm not too bothered. In fact, just to tell you, Mario, just this week, and the week before as well, I showed you, but this week I bought myself another gold coin here from. I went to Degussa to see what they'd got, and they've got a number, but a very nice. This is two kangaroos
Okay.
fighting. It's they're called Australian nuggets. They're £100 coin, sorry, $100 coins in gold. So I think the downtick in the gold price presents a little bit of an opportunity for those who've been saying, I'll buy on a dip, I'll buy on a dip. Well, here we are. We're definitely in a dip. I don't know if it's the bottom, but if you are one of those people who say, I don't want to buy at the highest price ever, well, here we are. We're not at the highest price ever now. We're several $100, three or
Yeah.
$400 below it. Here's your opportunity, but you better hurry up because it might not be there tomorrow.
Yeah, so I've got here a quarterly chart, which makes it more long term. And going back to before Nixon even closed the gold window, which was around here, or is it October? Uh,
August 1971.
yeah, right here. Yeah, around this time, July 71. So gold was already starting to go up. But what we see here, Clive, is that last quarter, the first quarter of this year, the market closed at 31.23. And right now we are at 30, let's see, 32. Where are we here? 3206. So it's come off a little bit overnight. But in yesterday, I noticed the low was 31 20, which was pretty close to the close of the previous quarter. It's interesting how it bounced. But so, yeah, looking at this chart, my point here is that it still looks very bullish. And yeah, nothing more than just normal up and down trading. There might be a little bit, I don't know if you noticed a couple of days ago, Clive, silver just dropped out of bed out of nowhere. I think around it would be 2:20 your time. I think that was on Wednesday. Could it have been bullion banks? Maybe, but I think, as you said, long term, they're not going to stop printing money and devaluing. Governments are not going to stop interfering and spending. They're going to find excuses for that.
I mean, I haven't bought any more silver since January or February this year. Um, I've been concentrating on gold purchases, which has proven to be the right way to go. And I think whilst I think silver offers much more upside, the trouble is you don't know when that's coming. Whereas with gold, we have lots of reasons why the gold bull market should continue, even if it's not going to produce as much as silver does in the long term. But it's a question of, you know, where do you put your money at a particular moment in time? And I feel right now the way to put your money is in the gold market.
Yeah, and I mean, I've got miners in the silver sector. I think silver will catch up eventually. And talking about silver, I just want to let the viewers know here in the UK that if you're interested in buying large amounts of silver, uh, gold investments can do that for you, but it's unallocated silver. It's not physical. This is for people who want to just bet on the price, basically, even though I think people should have physical. So, yeah, if you want to find out more how to do that through gold investments, I think the vaults for this silver, they're in Switzerland and they're held at Heraeus and Metalor. And yeah, it's a much cheaper way for UK if you're a resident in the UK because there's no VAT. And gold investments will also insure it. So if you want to find out more, yeah, to how to get in touch with Gold Investments, Oliver and Simon Temple. There's a link below in the description. And back to gold, Clive, there's been a lot of talk about Basel III and tier one assets and whether gold is going to be one or not. And I've been hearing about this for over 4, maybe 5 years. There's an article here, I think from December. Where is it? I'm going to share it here quickly. December, actually 2020. I don't know why it's in Italian here, but it's from website called kinesis.money. And so they're talking about this already back then. How will Basel III rules impact the gold price? And it says Andrew Maguire looks ahead to introduction of Basel III rules in March 2021. So he was saying it was March 2021. Now people are saying it's July 1st, 2025. So there's a lot of confusion about it. And just when was it? Yes, a couple of days ago, the LBMA came out because they say there's a lot of misleading in online information. And apparently, they're saying that gold has always been physical allocated gold has always been a tier one asset. So, what have you found out about this complicated, this
Yeah.
topic that is not very transparent, and there's a lot of talk about it.
Well, when you sent me that article, which came out a day or two ago, I think it was from the LBMA, basically saying nothing's changed for gold, I found it rather surprising because the internet is literally awash with hundreds of articles saying, or in words of one syllable, that gold is a tier one asset and it's changing under Basel III, and banks want to hold allocated gold instead of unallocated gold and so forth. Whereas they seem to be saying more or less the opposite here, the LBMA correction. So I thought that was rather strange. So I went to this morning. I spent some time on the the Bank for International Settlements website, trying to figure out which way the wind blows. And I searched for gold. I searched for Basel III and looked through the regulations. Now, the rules and regulations are, I'm going to say, hundreds of pages long. It's very complicated stuff. But I could do some searches on keywords, and I also ran some of it through AIs to see what I'd get. I think maybe the confusion. First of all, I'm going to say I think possibly the LBMA are right in what they're writing, that gold is not a tier one asset. Although, funny enough, I see in what the LBMA are writing, they contradict themselves in the second or third paragraph where they say gold is a tier one asset, which kind of confuses me. But putting that to one side, I don't think there's any, technically, I don't think there's any such thing as tier one assets. Tier one is to do with your capital and your reserves
Yeah.
and not assets.
Yeah, I mean,
But
Clive, can I interrupt you there? Yeah, I've always tried to say that to people because uh, the assets are, let's say, capital is how much a bank has to have in capital to back the assets that it buys. So the what gold is capital. So if you hold gold, it's part of your capital, and it helps you in the calculation of the weighting for weighing the risks of the all the assets that you hold. Isn't that it, right? So gold
yeah,
itself is not a tier one asset. It's a good 100% backed capital that makes those assets more. You can carry them. It's almost like, for example, the value of your house is your equity, is your capital, and then everything else, let's say that you own is there. Well, actually, I'm not. I'm getting a bit confused here. So let's say you buy a house for $100,000, and you have, let's say, 50,000 mortgage. Your capital is 50,000, not the whole house.
yeah, it's
So
reserves.
yeah, so gold is like a reserve. It's not an asset. So because people just use the term very loosely, and I think that's why the confusion was created.
So I looked at the Basel website. I found a clause which I think is where the original confusion may have arisen. This is clause 20.110, and it's a very short one. I'll read it to you. It says, and I read it slowly so your viewers can absorb it. The standard risk weight for all other assets will be 100% with the exception of the following exposures. One, a 0% risk weight will apply to cash owned and held at the bank, and B, gold bullion held at the bank. So, in that respect, they appear to be putting cash and gold bullion into the same bucket, which is what a lot of people are saying. But if you read on, it says gold bullion held at the bank, and then there's some extra words, blah, 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 blah. And then it finishes off to the extent that the gold bullion assets are backed by gold bullion liabilities.
What does that mean?
Well, it kind of says, provided you don't, if you've got an asset on one side and a liability on the other, you can set them off one against the other. You don't count your uh, gold asset as a risky asset if you have a gold liability. Because the risk on the liability side is the same as the risk on the asset side, so one cancels the other out. So I think that's what they're saying. Basically, it's not the same as cash if you hold it unless if you hold it on its own, it's not. We're not treating it as
Yeah,
the same
yeah.
as
Well, the
cash.
same thing with cash, though. If you hold the cash and you lend it, then it cancels itself out, doesn't it?
Yeah.
So, yeah.
So,
But
but I think that's where people have got confused. But I also ran it through all of the AIs I could lay my hands on today to see what the AIs, and all of them, bar one, disagree with what the LBMA are saying today. So I think the LBMA have got it right, actually, but all the AIs have got it wrong. So I ran it through ChatGPT, Claude Sonnet 3.7, DeepSeek, Grok, Microsoft Copilot, Google Gemini, and every single one of them basically said in words of one syllable, gold is changing under Basel III. It moves from a tier three asset to a tier one asset, and it will be very good for the banks and it'll be good for the gold market. But the only one which actually got it right was an AI called Manus. So the rest of them are, quite saying quite the opposite of what LBMA have said this morning, which I think LBMA have got it right. I also
the
looked up
LB,
what,
the LBMA also says that it's always been a like a like risk-free reserve
yeah,
to
um,
calculate tier one
but
weighting of tier one assets, right? Yeah.
yeah. So I think the key thing is every website you look at on the internet says it's all changing under Basel III. I mean, for example, if you Google Forbes and Basel III, you'll find an article of a couple of days ago, which literally I'll just bring that up for my machine here. Have I got it here?
I can
I've
allow
lost
you
it.
to share it if you want.
There it is. Yes, okay, I'll share that one. Uh, Share. Uh, and here it is, Google
I'll just,
Chrome.
while you're doing that, I'm just going to say that the reason why I've been acquiring gold for over 20 years and in the last few years is not because this talk of Basel III. And I think, yeah, it doesn't really matter. You know, gold's gone up despite everything. And I'm also going to refer to this book here, Clive, when you finish looking at that, the Tower of Basel, because they talk about gold here. So, what's this? Yeah, you see, even Forbes, gold goes full reserve asset as Basel III elevates it to tier one status, which is wrong, really.
And that's an article
It's
from two or
always,
three days ago, May the 12th.
yeah, because it's always been a tier one, it always, as a reserve, it always contributed to the tier one weighting calculations. That,
So, yeah, it seems the entire internet is convinced that something's changing under Basel III for gold,
yeah.
whereas LBMA says it's always been like that.
Yeah. And so here on page 264 of this book, which is a really good book that exposes the BIS as being, well, during World War II, they financed both sides. But it says here, the new emphasis on gold can only be good news for the BIS, and it is a return to the bank's roots As Gianni Toniolo, the author of the BIS official history, notes, the gold standard fixing the value of a currency to a weight of gold was embedded in the very DNA of the BIS. The gold standard is long gone, but gold prices continue to rise, and gold will still has a powerful hold over investors' psyches. It is certainly ever more central to the BIS's banking operations, so much so that the FT has described the bank as the ultimate bullion pawnbroker. The BIS 2012 annual report revealed that the bank holds 355 metric tons of gold in connection with its gold swap contracts, meaning that the bank exchanges currency for gold, which it returns at the end of the contract. So gold is important to these people, even though, yeah, we're critical of them. And also, when it was founded in 1930, Clive, I've got the documents. This it's public, the statutes, and all the banks that were shareholders. They contributed gold, and it was gold francs. It was called, and they gave the amount in hundreds of millions of grams. How much was put into the BIS capital? So there you go. Clive, any final words before we wrap up here?
Well, I think there's something important. Let's assume the LBMA are right, and I think they are in this saying it's a misconception that Basel III is changing it for gold. Therefore, what everyone's saying is that gold has to move into the banks for physical. That's rubbish. So I mean, there may be a vested interest in saying that because obviously gold is leaving London and going to New York, and a lot of people are saying it's going to New York because the banks want to have the physical allocated gold in their vaults ahead of Basel III so they can count it against their reserves, which now LBMA is saying that's not true. So that begs the question, why is all the if it's not true, why is all the gold going to New York? Who in America is taking delivery of all the gold? You know,
Yeah.
it's not what we thought, or it's not what some people suggested. It's certainly not the bank saying we've got to have gold in our vaults anymore, because that's not necessary if this what they write is true.
And if the analysts like Stephen Jen are concerned about treasuries, and if the regulatory regime allows banks to hold more treasuries, but if treasuries are going to become riskier, would you, as a bank, only want to have treasuries as backing your assets or your operations? You'd want to have gold, I think. So yeah. So there you go, Clive. Thank you for coming on, and I think it will be okay for Sunday if you're okay for the live stream.
Uh, We've got a barbecue on Sunday. I think I'd better say no, Mario,
That's
for
fine,
Sunday. Sorry about that.
but I'll be back on. I wasn't on last Sunday, but I think it should be fine for me. And with that, I'm going to wish you all a great weekend, and you as well, Clive.
Thank you very much. Great weekend to everybody, and get stacking.
Yeah.